The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, boys and girls, welcome to the afternoon session of TFNN. We're going to start off with the Bradley model because what we had happen Friday, I think, is very, very important in technical parlance. We made the exact 61% retracement from the mid-April low. That came in at the Dow of 14,900. And my prediction is if we get below 14,900, we're going to see something very dramatic to the downside. I've been looking for a place to, to officially be short. I'm already, of course, most of you know, I've been very bearish for the past week or so, actually since the lunar eclipse and full moon of May 25th. But to me, we hit the exact 61% retracement on this Dow on Friday. And if we turn around and go below it, then it's going to be very, very negative. Now, whether we do it today or whether we do it tomorrow or maybe we don't do it at all, but the faster this rally ends, in other words, it only lasts a day and a half or 2 days or possibly three, then we'll be looking at something really more sinister. In other words, the market would start to pick up momentum to the downside. The problem that you're going to have with me until this market proves me wrong is that I have an incredibly bearish bias. Sometimes I'm more bearish than others, but this is the most bearish I have been on stocks in my whole career. And I was very bearish in October of 2007, as most of you remember. We were making a big top with the Bradley model and expansions like we've had. But this one is the mother of all tops, in my opinion, and we're seeing it across the globe. And we see it in Germany, we see it in France, we see it in also the UK, and we'll see it now. We've had a pretty big rally in the Nikkei, but it's still just made a 786 retracement of the high that we made 2 years ago, so that's really not doing very much. Now, the Nikkei is having unbelievable swings, folks. I mean, 3 and 4% a day is becoming, rather commonplace in these markets. I believe the Nikkei was up almost 3.5% overnight, and when it drops 3 to 5%. So these are the things that that makes it work. We will cover the Treasury bonds also, and we will look at those because if we get Treasury bonds below 138 in that September bond, this market could really start to melt down, and interest rates could really spike. And spiking, if you get a 1 or 2% rate from here, that's a substantial amount. It's equivalent to about 5 to 8 points in the bonds. So, but we need to get them below the 138 level because we're very close to a bigger A, B, C, D level in the bonds that I will post, a little bit later. But right now I wanted to talk about stocks because I believe that what we're looking at here in the stock market is something that we haven't seen in many, many years. Now, the next chart that we're going to talk about that I put into Tiger TV is the New York Stock Exchange Index. And basically the low that we had that came in on Friday was a 61% retracement of the April low, just like we had in the Dow Jones Industrial Average. It was also the low of the May low, in other words, the low of May the 2nd. And so, that sell in May and go away thing is still working, but we need to get it to go below Friday's low. So Friday low is the key thing to watch in the stock market, hands down. I've never seen one as technically easy as this. In other words, if we go below that low that we made Friday, that means we've broken the 61% retracement, and we did it very, very, if we do it quickly, and I'm not saying we will, but if it does do that, then we're looking at something very, very sinister in the market. It's very, very important to remember that. There's several others that look the same as bearish as the other, but I wanted to do the NASDAQ next because it has been the leader along the way, and that one is has completed the big ABCD on the daily, almost to the exact price, and then we came down, and whereas the Dow Jones and the New York Stock Exchange Index made, and also the S&P, made the exact 61% retracement off of the April low. The NASDAQ did not. The NASDAQ only made a 382 retracement. So this is a major thing, because if you're really bullish, this gives you a lot of bullishness to say, yeah, this market still does look bullish, because the NASDAQ could only make a 382 retracement. And it's really strong today, and as a matter of fact, it's already at the 61% retracement. I'm going to have to make a little correction here to make sure that these charts get in there properly, because sometimes I'm not being technically adept at these things, and hopefully it'll be posted in here, and you'll be able to see it. So that's what we're looking at across the board, and that shows the importance of Friday's low. To me, that's going to be the ultimate sell signal. If we go below Friday's low, just get short, folks, because all your risk will be is whatever this high happens to be during this next rally that we're in right now, and then you just wait and see what happens. I did a lot of research work on this over the weekend, looking at this thing and making sure that all the numbers that I was looking at were correct. And I ran it by some people who I, really respect, and they were actually, surprised at some of the numbers that were coming together all at the same time. So these are long-term patterns that I'm looking at. This is, a very, very sinister pattern, very similar to the one in 07, but even more similar or more scary than the one in October of 2007. I know the financial press is telling us that everything is okay and wonderful again, but frankly, I have a hard time believing that, and because I don't believe what the bankers are telling us anyway, because it's their job to lie to us, and they do a great job at it. So it's the charts that count. If the prices are going up, there's more buying. If prices are going down, there's more selling. That's the bottom line of what we're looking at. But the importance of Friday's low from a technical basis cannot be underestimated. Now, we had the situation that we've been watching because we were very, very bullish, the VIX index, and, we had that occur, and hopefully the VIX index chart will come into the room, and you'll be able to see in Tiger TV the ABCD pattern that formed Friday, going, taking out the highs of April, and now you think we're down into this area where we should get some support around 14, somewhere between 1450 and 1395 in the VIX is what we'd be looking for some major support. Someone has posed the question, do you think this will take gold and silver down as well? These are different markets. Gold and silver are totally different markets than we have with the stock market. They're different people that trade these things, and it's a totally different group of people. But we are going to talk about the gold and silver later in the program, of course. But right now we're focusing on the stock market and what's happened, and the fact that the VIX was able to take out that high from April, and Basil on his shows said several times that he thought that the VIX would get close to that 19 level, and we did get to 1845, which took out the April high and made a perfect ABCD at that point, which was on Friday, which was one of the triggers to say that the market was probably getting ready to have a oversold bounce, because we were oversold at that time after being down 5 or 6 days in a row. Someone made the comment here that the metals and the gold and silver and stocks all went down together because there was a major pulling back of deflation of what was happening during 2007 2007, and a lot of that was margin call selling because much of this buying and stuff that goes on is related to margin. And if prices go up because of margin, they can also come down. And as stocks come down, the brokerage companies ask for more margin. That's where you get the margin call. They're calling for more margin because they want to protect themselves against something, very, very sinister to happen. That's why, John Corzine, basically bankrupted MF Global because they didn't, adhere to the margin requirements that they were supposed to do. They broke the law. They robbed the bank, but, they didn't pay for it. None of those guys are in jail. Somebody goes into a 7-Eleven with a plastic gun and robs $50, he spends 35 years in prison. But these folks, they don't go to jail. They get elected to Congress. Ah, what a great country we live in. We should be so lucky. Anyway, I still believe that we are in the beginning stages of what I think is going to be a life-changing bear market in stocks. And I could be wrong. And if we get above 16,000 in the Dow, I certainly will relinquish my technical analysis baton on a long-term basis and go back to trading 15-minute and 30-minute charts in the currencies because I am really good at that, and maybe not as good as I am at the long-term prediction, but this one is pretty clear to me. I might be wrong, but right now it looks pretty clear to me. And as we proceed through this rally that we're having now, we'll see what happens. But if we close down for the week, below Friday's low, get ready, folks, because you're going to see something as nasty or nastier than what we had in 2007. And I know that the housing market is back to where it was in 2006. At least that's what they're telling us in the financial press, and everything is okay, and all the debt problems are done and everything like that. But if that's the case, then why are the price of bonds going down? Interest rates are going higher, folks, and that's a very, very negative thing. We're finishing a 33-year bull market in interest rates. In other words, interest rates have been going down for 33 years. That ended in November of 2012 with bonds at 154. So what we're looking for now is higher interest rates, lower stock prices, and the potential from some deflation. We're not sure yet on that because we still have crude oil, held up above that $90 a barrel level, and gold held at the 50% of the last retracement, which is good, but we're still quite close to really interesting things happening. We're going to be getting ready for our first break, and after we come back from the break, I'm going to move to the gold and silver market, and we'll cover that. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
What we're going to look at is the gold chart. And what I did in order to see it a little easier, I broke it down into a 30-minute component so that you're able to see it going back to the lows we made on May the 19th when we were at 16. I keep getting this S&P and the gold messed up, at $13.35 per ounce. And what we did between Friday and today, we have made a 50% retracement in the gold down there at this 1377 level. And, right now we're trading around 1382. But whether it's going to rally from here or not, if the flag is still up, we really don't know, what direction it's going to go. We had this big sell-off that happened to come in right at the 61% retracement of the high from 1485. We stopped exactly at that 1423 level. Actually, the number was 1424. We got to 1423.80. And then we sold off to the 50% level. This is the second major correction that we've had after we hit the 1480 level. So this is the important one, what happens from here. The silver market has actually been holding up, pretty good. It's been, not dropping as fast as gold, for the first time, in quite some time. And so that's giving us a little bit, not much, but just a little bit of, what could be happening, to these markets if they can hold. Silver needs to hold the 2140 level without, going much below $21 per ounce, and we're at $21.87. And believe me, 80 cents in silver is not much anymore. It used to be, a lot, but now it's not. So, the gold, the bottom line is if it can hold 1387, it's got a chance. But frankly, I think we're going to go down to the 61% retracement, go down about $20 lower, around 1355, and we'll see, if that holds up. Silver is more difficult to trade because it's less liquid, and so you have to, figure that in if you're going to trade silver. You can trade gold with about an $8 stop, around $800, pretty easily against these numbers. But with silver, you have to risk, quite a bit more, usually about 30 cents, because it can move quickly, and it is less liquid. It's only about 1/6 the liquidity of.
And Larry, please let me say is that I don't know. And I don't, anyways, have your experience. And with this particular trader, what he was saying, and maybe I didn't articulate it, he was just saying and he's a pattern trader in futures, but he was saying that that he wouldn't initiate either a long or a short position of a major way in the last week or two of a contract. And he was pointing to gold 2 years ago, saying that gold, when they flushed them out, they just pushed right through to June, and then it was after that she kind of gave up the ghost. And I just didn't know if there could be, this kind of thought, like, hey, anyone who's still short this June contract is going to have to be pushed on out, or kind of, I don't know if squeeze is the right word, but
no, squeeze would be the right word. That's because that's what happens. You do get squeezed if that's the case. Now, I think that one thing that might have an effect on these futures, especially the stock index futures, as you roll from the June to the September, like we're going to do on Thursday, the liquidity in the June starts to drop, and liquidity in the September starts to rise, and that few days there where you have the triple witching and stuff, could have an effect. But frankly, I don't see it. I trade them, all the time and into the, switching over and everything, but I have not seen that. But and I haven't seen any definitive studies on it either. So I will give it some thought. Maybe I'll ask a few people, but I have not seen it.
In this particular trader, he was pointing, and I'll let you go, he was pointing to two incidents of gold in June 2 years ago, and then when silver topped out at 50. He said that came in the last 2 weeks of witching.
Well, the silver top out was a flat-out no-brainer. I mean, we were here in TFNN, and, there were people in the room, Mr. Z, and, Bob from Saratoga and other places that we were talking about the drop in open interest that was going on in silver at that time in April. I mean, prices were going straight up, and open interest was dropping. That only can happen with one thing, and that's shorts getting out of the market. That was a short squeeze.
The futures
but once that was over, it was over,
This month's roll this week?
I don't know. I'm not sure. The futures for the S&P, they roll this week. That's correct.
Okay.
Yeah.
It'll be a moot point, I guess. So,
yeah.
Larry, thank you, and I look forward to you.
Well, we'll watch it to see what happens, and maybe come on next Thursday, and we'll see what happened over the time.
All right. Thank you, Larry, for all you do.
All right. Thanks for calling in, Mike.
Bye.
Okay. The next thing we want to focus on, folks, is the copper market, because we've done gold and silver, and I needed to take a little bit of time to look at copper, because this has been probably the biggest divergence that we've ever seen in these markets. In my opinion, because, there's a correlation between copper and stocks, at least it had been up until October of 2012, of better than 85% correlation. In other words, if copper went up, stocks went up, and if copper went down, stocks went down, and that has completely gone by the wayside. I mean, we've never seen one this bad before, and it's basically telling me that the products that they're making using copper, electronic stuff, automobiles and toys and things that use electricity or batteries, it's just not, they're just not being made as much. I mean, if they were, why wouldn't people be, buying copper down here? And we're down another 3.5 cents today. The most we could rally was a paltry, 10% off the last swing, which was basically a 50% retracement off of the high of the year, which was done in, late January. And, and stocks went, ballistic to the upside. So my feeling is they put a giant blindfold on the stock market, and it's just going to be a matter of time till the band starts to play and the proverbial chubby little lady starts to sing. Who knows? But that's what I'm seeing. This divergence that we have in copper means a great deal. People don't talk about it much, but when you look at the charts and go back and look at history, this is an outlier event, folks. We don't see things like this, very often at all in these markets, that we look at. Now we need to take a look at the bond market because that's the biggest market of them all, and we're getting ready to complete a major ABCD pattern here in the bond market. We are only about a point away, well, actually about 2 points away, down around the 137 level, and that should be pretty strong support because that'll take us to, where we are near the lows of January of this year. In other words, we'll be ready to take out the lows of January. In other words, interest rates will be higher than they were in January of last year after they, they dropped a little bit and now they're starting to go higher. And that's what we're looking at, in the bond market. It looks, it's been bearish. We've had this monster head and shoulders pattern that we've talked about here at, Tiger TV for quite some time. And, it looks like, the only good part about this is I don't have to ride in Tom's boat because, we had a little side bet that, we thought that bonds could possibly go to 160, and it doesn't look like that's going to make it. So that means that I don't have to ride in Mr. O'Brien's boat, which is really a blessing in disguise, but I would rather walk on the hot coals of a volcano than take a ride, in a boat, because I am not a boat person under any stretch of the imagination. Now, we need to focus again on the interest rate markets by looking at the long-term weekly chart in the Treasury note market, because the note market is about 3 times bigger than the bond market. That's the shorter-term rates from anywhere from 1 year to CT bills are from 30 days to 1 year, and then you have notes go from 1 year to 10 years. Actually, it's about 7 because they have a 10-year bond in there, too. But the notes are very, very bearish, and if you'll take a look at the head and shoulders pattern on a long-term weekly basis, I mean, it's broken. It's been a textbook. It certainly has. The right shoulder was exactly, 61% of the previous one, and that's it. Folks, I don't want to get on I'm going to get on my soapbox one more time since it's my show, at least for today anyway. But I am really bearish. I mean, I don't want to scare you, but if we go below Friday's low, you better be careful because we're going to see something that is going to shake the tree. I don't know what's going to cause it. Might be higher interest rates. It might be something from Japan. Could be something from Europe. I don't know. But something's going to shake the tree. And if we go below Friday's low within the next couple of days, either Tuesday, Wednesday, or Thursday, look out. That could be a war. Someone mentioned it could be a war. But heck, we're always at war. It's either Vietnam or Bosnia or Afghanistan or Iraq, Iran. We're always look at Vietnam. Heck, we probably still have troops there. I wouldn't be surprised if we didn't. But it's a big machine. It's a big machine, economic machine of the business of war. If you look into, well, I don't want to get into politics. That's not my business. Anyway, the notes looks like they could drop 5 points really quick, which would send short-term rates up about 1%. That would really be a shock to your mortgage markets, and they're trying to stimulate the mortgage markets now with the situation that if we have higher interest rates, it's going to be, we'll see. Anyway, they're supposedly, they're talking about whether they're going to stop these QE2 programs or QE3, whatever it happens to be. I'm not even sure what those things mean. No one's been able to explain to me with any great deal of clarity what the Fed is doing because it's just a giant experiment, and that's all it really is. It's nothing more than that, and we have to be able to understand that's where we are. Now, on Friday, we're going to switch over to the currencies here now because on Friday we had an interesting situation happen. We had a perfect ABCD pattern complete in the euro, and we had a little bit of a sell-off, about 100 pips between Sunday and Monday, and now we're making a retest here to see if the market's going to be able to get above this 133 level. Now, the dollar index has, made the double top that we've talked about over the past 5 or 6 weeks, up at that 84.50 level, and we back down to the 8100 level, and that should be the end of it if that's going to, that's going to be the case. So that's the main thing that I'm watching with the U.S. dollar. The British pound does have some resistance up in this 156 level. We're trading about 159.69 right now, and that's the broad thing to look at. Someone has asked the question if I'm looking at the price of the Dow Jones going below Friday's lows at 14,900. What would be that equivalent price in the S&P? Well, that equivalent price in the S&P would be below 1590 in the June futures and 1586 in the September futures. So that's the other thing that you want to keep in mind. Just look at Friday's lows, folks. That's really what you really want to be looking at. That's the main thing that I think is very, very important. So I wish these long-term charts are just so ungodly bearish. It's actually quite scary. That's the only way I can define it. It's just that scary. I want to talk a little bit about our friends in the land of the setting sun. We'll get back to Japan, and I want to show you the importance of what happened on Friday in the Japanese yen versus the U.S. dollar. We had our first major correction in the last 3 months. The market dropped well over 7 points, and it stopped exactly at the 61% retracement of the April lows and 786% of the 61% of the February lows and 786% of the February lows of the April low. Let me say it again. Try to get the words out correctly. It made a 61% retracement off of the February 25th lows, and it made a 786 retracement off of the April lows. And that's what hit the market really quick. Now, it's had a very strong rally of almost 4 points very, very quickly. And this, to me, is the layup trade of the year, because Japan is in such a bad situation that they cannot work out of it. They've been these interest rates in Japan have been down for decades, and now as interest rates start to rise on a global basis, people are not going to want to borrow the yen, and that means the yen has to drop against the U.S. dollar, and that means the dollar is going to strengthen against the yen, and that's going to be a really good long-term trade. Remember, the yen at one time traded at around the 260 to 270 dollar, 260 to 270 yen per the dollar. Then it went down, made the bottom down around the 72 level. Around 75, Tom O'Brien, he brought out his famous quote, King Dollar, and that 75 level in the Japanese yen proved to be, the ultimate bottom, and we made that level 3 times. We tested it 3 times, and then it had the huge move where it moved well over $30,000 in a matter of 6 months, and now we're just digesting part of that move, and it's getting ready for another move. People ask the question about printing the money, to pay for the debts. People are not stupid, folks. I mean, they might be a little naive, but they're not stupid. If they see that that's what's happening, what's going to happen is they're going to start dumping them, and it's going to happen sooner rather than later. And also the thing that's going to happen is if they start doing that and other countries start doing that too, then the price of gold, which is a hard asset, and the price of silver, they will start to move, because that's telling you that, the money is not nearly what it is. This is a Chinese curse that we live in, folks. We live in interesting times, and that is from the era of Confucius around, I believe, 600 BC, and that was a Chinese curse. And he said to the person, may you live in interesting times, which was, something, like if we would say, I hope you die a horrible death, because that was the meaning at that particular time in history. So when they say live in interesting times, that was not just being an off-the-cuff comment. It was a derogatory amount, or a derogatory statement. So that's why we're looking at it. The Japanese yen is a great thing to trade. It's pretty hard to buy it now because we've moved, well over $4,000 off the bottom just last Friday, and it really is you just want to be able to buy it on a pullback. If you get a smaller ABCD pullback in this down to that 96 level, I think that would be a very low risk. This is one that I think it's going to write the history books. It's already started so dramatically from 75 to 103. This thing has got a long way to go, because remember the ultimate high back then in 1989 when the Japanese government had the Nikkei trading at was it almost 40,000. We got to take a break here, folks. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
And down the stretch they come into the last few minutes of the TFNN show for today. We got our friend from Philadelphia. John, are you there?
Larry, good day to you, sir.
How are you, my friend? It looks like you're going to be right on that corn again, buddy.
Yeah, the good weather Mother Nature is going to provide the next 2 weeks may kick things off going lower, so we shall.
Yeah, we're
see.
hoping that we can get down there another 20 cents lower because we'll have a nice place to see if it's going to hold that level. What can I do for you, my friend?
Larry, I wanted to first just thank you on the clear parameters you set forth regarding the Dow. I wanted to reemphasize the VIX chart, and I think you just posted that, but the VIX peaked at 1850 last Thursday when the Dow bottomed right at Fib 618 support. Right now, the VIX, interestingly enough, is coming right into its respective Fib 618 support level. That just so happens to be a key moving average. Basel used a 200-day exponential moving average, and that's right at that same.
I heard that
level.
today, yes. It's very important how it's coming together.
And Larry, I didn't hear you mention today, but you've said this before. I had to repeat it. You had observed months ago how there was a very reliable 35-day trading cycle that seems to operate with the daily VIX chart, and that is bottoming here in mid-June, right as the Bradley model peaks out. So that idea that you shared of certainly getting out of all longs and being short if last Thursday's Dow Jones low is penetrated, gosh, that just sounds like a real easy, real clear idea.
Based on numbers, it looks like a no-brainer to me because you're seeing it in the NASDAQ, the S&P cash, the Dow, the New York Stock Exchange Index. They all hit perfect fib numbers. And so if you believe, that, you're certainly, seeing something that, what I think is incredibly important. I've had a request to put the VIX index chart in one more time into the den, and I'll be happy to do that. And, that's what I'm looking at. John, you've been doing this for a long time, and you and I chat off the air quite a bit, but long term, I have not seen things this bearish before. I look at bonds, I look at stocks, and it actually scares me when I see the stock market, where it is and the patterns that are forming with these expanding triangles and three drive patterns. It's just so ominous that it's, I wish it was turned upside down and we were coming out of a depression because this thing is really scary to me.
One last addition to that idea, Larry. Basil has made great commentary over the past weeks about what the implications would be for the stock market if selling in the options market picked up and the VIX exceeded 20. And if the Dow happens to break last week's low, and if coincident with that, the VIX rallies over last week's high, you get into that territory where Basil has, studied research that would seem to indicate further selling would be highly likely with a VIX, over 1920. So it's certainly a thing to watch.
Well, that's what my eye is on. So, you just basically have to circle the Dow, at 15,900, 14,900, and you circle the S&P below 1,590, and I think that would be the kickoff. But, frankly, if you're bullish, not a big problem. John, thanks for joining us today, my friend. The show's coming to an end.
Thanks, Larry.
You bet. Thanks, folks. We'll see you on Wednesday.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.